VistaShares Targeted 15 ETF funds. Are these good for retirement or a yield chase? A 15% yield return off of ETFs? Let's find out. Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy, and today we have a deep dive into all of the VistaShares Targeted 15 funds. Now, if you're not familiar with these, comes from VistaShares, and they put together a Targeted 15, which is they're targeting a 15% yield on these ETFs. We actually got a comment from one of our Patreon supporters asking, where does these fit? Do these fit in the income section? Are they in the growth section? Well, we've broke down some of the funds. We've never done them all because some of them are so brand new. So I thought let's put this all together as one big giant package so you can see where each one of the funds fit. So with that, we're going to get into the Targeted 15 ETF. Are these good for retirement or are these just yield chasers? Let's get into today's video. The VistaShares Targeted 15 funds. There are 5 different funds that are out there. These are strategic overview is the VistaShares provides a suite of ETFs designed to deliver a roughly 15% annualized target return through active income strategies. Now remember, these are targeted. These are not guaranteed. The 15% annualized target, historically driven by sophisticated income layers, covered call strategies. They use these basically 4 different pillars. They do covered call writing, options and derivatives, high dividend yields, and dynamic rebalancing. And the distributions are paid out monthly. So remember, all these distributions are not guaranteed. These are just targets that they use. And they have a wide variety of funds with these 5 different ones. And the biggest one and the most popular being OMAH. And that's OMAH, the VistaShares Berkshire Hathaway Select Income ETF. Let's break down each and every one of these, give you what they're good, they're strong, their weaknesses, and all their risk factors together, and see if this does fit in the retirement package. Now, before we dig any deeper, we have to do the disclaimer, and that is past performances do not guarantee future results. This information is provided for educational and informational purposes. If you need financial advice, always contact a professional. So the Vista Targeted 15 income-orientated retirement solutions. Okay, these things are retirement focused. They're designed for investors seeking consistent cash flow, targeting a 15% annualized yield. Okay, when you take a look at this one, you have the typical ETFs, which are anywhere between 0 to 2%, which are typical. Those means non-covered calls, just basically little simpler funds. Then you get into the high yield bond funds, which are generating that between 4 to 6% range, with VistaShares targeting that 15% area. So does this mean that they're part of the bonds and security funds? I think we're going to dig deeper and find out the answer to that one will be no. Let's take a look at the core strategy. And this is the first core strategy that they use is what they call covered call overlays. The covered calls generate immediate income, or better known as premiums, by selling potential upside of an equity position beyond a certain price. So the strategic impacts, it generates cash flow regardless of market direction. It provides a buffer against minor market declines and limits participation in sharp bull markets because of the covered call strategies. It requires an active management of a strike price. So when you can see here, what they do is they own the underlying asset. 2, they sell those covered call options at a strike price. They receive premiums, which is that immediate cash flow. And then they manage the exposure by adjusting their strike price on volatility. That's your covered call overlay of the core income engine of these funds. The second core that they use is dividend and yield focus. Now, the key insight of this is a blending option premiums with high yield income sectors, and the fund aims to provide a more robust and consistent distribution than pure equity plays. So these guys are going to be into the energy infrastructure, the MLPs. They're going to be in the REITs, the real estate income. They'll be looking for blue chip equities and dividends. They'll also be looking at premiums from the options overlay. So that combination is what's giving you your core income benefits. The strategic goals is the yield boost, the diversified income, the dynamic exposure, and the risk optimization. So a neat little strategy that they do use. 1, the covered calls. 2, investing in things that will generate income as a whole. Then the total return, and that is your income yield plus your NAV performance. The key insight, actual investor returns are the sum of cash distributions and the movement of the net asset value, or better known as NAV. The high yield does not guarantee positive total returns. And remember, on this channel, we always look at total returns because that's the true number. So these things are looking at, like I said, an estimated 15% targeted yield, only targeted, not guaranteed. They will have a variable NAV price return. Their options are that premium income driver, and the equity is that premium NAV driver. So when we take a look at this, what would happen? And you'll see in the brown, we have the return price, the NAV movement. And then the red is the income yield. So in a bull market, they're looking at a 0 to 15% of yield with about another 5% of price return. Why does that seem so low? Because of the covered call options. In a flat market, they're expecting to get their 15% of yield income, but really no growth. And bear markets, they're expecting to get their 15% targeted, but they can have a loss of easily up to 12 to 15%. So the first fund that we're going to take a look at, and this is the VistaShares Targeted ACKY in distribution ETF, better known ACKY. It mostly invests in total market equities. The fund is actively managed and invests in U.S. listed securities based on the BATA VistaShares ACKY Activist Select Income Index. Additionally, it aims to achieve an annual income target of 15, distributed monthly. When we take a look under the hood, this thing has $54 million in assets. The expense ratios you're going to find at 0.95%, which is $95 for every $10,000 invested goes to expenses. Now the distribution yield, 6.40. Don't go crazy yet because this fund has only been out since September, so it's about 5 months old. Okay, so 5 months, double that, you're at 12%, so it's right on target of hitting its 15%. When we take a look at what it invests into, well, they're heavily into consumer services, transportation, diversified financials, media and entertainment, real estate, and retailing. The performance so far since inception, since this fund's so new, we have to look at the inception, you're at 10.90% total return. So when I start doing some legwork into this over the past year, I want to see what actual funds, when you say since inception, this is since September, but what's really going on here up to date? Well, so far they've had a loss of 1.86% in growth. So that's NAV loss. They've had that income of 6.40, which is on target for their 15. But their total return is only 2.75 over the past 5 months of data. So the real key here is you're going to get probably your 15%. But if they don't correct their NAV, if they don't correct their growth side of it, their total return is actually going to be down. So this is one being a new fund. Where would you put this in at? This would not be a fund that I would put into a retirement package yet. I would wait 12 months to really see what the thing performs. Now, the thing that it looks at, it doesn't have that technology that's going to give you the big returns. That's the big growth. What this is giving you is the real estate market. It's giving you the transportation, the consumer section. Are these powerful funds? I don't know. I don't really understand that one yet. I don't know if it's real estate with the interest drops could create some money. But I just see the 15% coming in, but the total return is what scares me. Now let's take a look at DRKY. Now DRKY is a fund as a microeconomic strategy to all cap U.S. equity investments. The fund holds the top publicly disclosed holdings of the distribution, and I know I blew that one, family office, a private investment firm of Stanley. This one has $19 million invested into it. Again, expense ratio 0.95. This one came out October 8th of 2025. So again, fairly new fund. Distributions 1.07%, 5.13 distribution. Again, only 4 months so far. But look what this one does. Pharmaceuticals, retailing, capital goods, semiconductors, the software services, banks. This one has a lot more diversification, but again, is not dialed into any technology side of it. Now, since inception, again, we're seeing this at a 27.94% total return, which bothers me because when I do my research and get my numbers coming back from it, I see that they've had a good growth of 3.48%, which is a positive, and they've had a 5.13% income. But their total return right now is 8.61 over 4 months. I personally like this fund. I do not own it, but I personally like it. The numbers, the research I've done shows me that this thing will achieve its 15% targeted fund unless something happens in the near future. But it's also having a nice growth pattern as well with it. So this one could easily be, right around that 18% total return at the end of 12 months. Still only 4 months old. I'm going to stick to my guns and say, guys, we need to make sure that we're 12 months or older before we're putting any of these into a retirement fund. But if someone's looking for some income, this is a potential. DRKY is definitely a fund that looks very enticing with a nice total return of 8.61%. Now we go into the SIOO, which is technically the S&P 100 distribution. This one, when it came out, I was very interested into it for a particular reason. I think dialing it in to that S&P 100 versus the full 500 could give you some advantages. You're going to pluck off some of the higher levels and the higher pieces of it, like you'll see here. The informational technology, over 38% of their fund is technology. Communication services, financial, consumer discretion, healthcare, all are in the double-digit categories. Now, the fund came out December 11th, so really we're talking, as of today, we're only exactly 2 months old. And their system is this. They got $3.9 million in asset. They did something excellent expense ratio of 0.59%. So it definitely lowered it down from the other funds. Now they've had the distributions, really only 2 distributions of 50 cents for 2.55% distribution yield. When I do my math on the numbers, you see the fund is actually down 0.91%, and it's been that over the past month, and realistically over the year to date up 0.46, but we're making up for that December run. Income 2.55%, 2 months old. You're real close to hitting that, again, targeted number, but total return 1.24%. So being such a new fund, it's still something in our radar that we're going to continue to watch. I will not invest in any fund. My minimum is 3 months to 6 months. So this one is only 2 months old. It's on my radar to continue to watch. But if it's going in my retirement package, it'll be 12 months old before I invest at all into this fund to just see what happens over a 12-month period. But I like the setup that it has with the S&P 100. You can see it's more dialed into more income generated pieces with real estate, utilities, energy. So that's why I can say that the income target looks very promising, but you got to make up for that growth. And that's where 2 months old just not enough time to really judge that one. Now we get into QUSA. And this is the VistaShares, again, targeted 15 U.S. quality income ETF. The fund seeks to generate that 15% by using U.S. equities and active option strategies. The fund aims steady income alongside potential long-term capital growth by prioritizing strong financial stability and low earning volatility. So what did these get into? This one here has been out a little over 9 months already. $17.39 million under assets. Expense ratio 0.95. They've paid out 11.97% over those 9 months of distributions, or a total of $2.18. Now this fund here, again, this is probably one of the most diversified funds that I found so far. It has the diversified financials. It has capital goods. It has commercial and professional services. The one thing it did not have really was the technology, which I was surprised at, that they didn't have technology and are able to generate the income that they have so far. But they like areas that I definitely enjoy, of the utilities, the real estate, as different funds than just technology. This is why these funds start to get very interesting when we start talking about them, because they're not dialed into technology. They're into other areas that generate income across the board. Now, how is this fund developed? Over 9 months, the growth rate is down 7.78%. That is extremely high in 9 months. The income 11.97% for a total return of 3.71%. What will happen in basically when it hits 12 months old? Well, we look at year to date so far in 2026, we're seeing some strong numbers of 2.38% over basically month and a half. And 1 month they're up 1/4 percentage point. So are they recovering on their growth? Well, you got to remember that's including the income side of it. So this one, again, we see that they can obtain their 15%. The question is, are they able to hit their growth point of either 0 or above? And unfortunately, in this market that we've had so far, it's not holding its own and getting down to 3.71. So I was excited about this one, just does not hold the mustard so far. And then the final fund that's been out here since March 5th of 2025. So we're almost a full year into OMAH. And I will tell you this, Berkshire Hathaway Select Fund, when it first came out, I was excited about it, thought it was something unique. I invested into it. I'll tell you up front, I am invested in this fund. This one here follows the Berkshire Hathaway positions. It employs the covered call strategy and generates income that the Berkshire does not. $678 million in assets. So this one had a lot of hype going into it. It had a lot of interesting pieces to it, which is we've covered a couple items because we keep an eye on this one very well. But look what it's done. Technology, 17%. So again, that technology will tell us, is it doing good, bad, or ugly compared to other funds? And what I like about it, 17%, I can put this with an S&P 500. I can put this with a NASDAQ, who are sitting closer to that 30, 40, 50% category in technology, and still not have duplication or overlapping because I have such a small portion in technology. The consumer services, finance, energy, healthcare. The reasons why I personally got into this was exactly this. I now have a fund that's covering healthcare, energy, and it covers all the finances. That's a majority of it. So it's something that a lot of other funds have. They may have a touch into it, but not as big as what this one gets into. Since inception, they say 7.72%, so we're darn close to our numbers. In the past year to date, again, a month and a half, 0.62 gain, and over the past 4 weeks, it's down 0.12%. So knowing this and owning this, I come back and tell you, am I pleased? Yeah, not really. We've had the growth loss. We've lost 6% in growth. We've gained that 14.19%. So I really truly believe that number will come in at that 15% above. The total return though, 7.52. We may get to 8. Honestly, we may get to 8% when we're all said and done. So am I excited about this fund? Well, 8% is nothing to, total return of 8%. It's nothing to cry home about. It's nothing to get excited about. But it does fit in honestly, it fits real well in my retirement portfolio. But it's down the list of actually number 5 or number 6, I believe, in my total return income category. Because I can't look at it growth. I have to look at it as income because of the losses in that growth side of it. So I have to look at the income of getting that 15% targeted return, which is not guaranteed, but then looking at the total return, which is what I do everything. And you should do the same, is always look at total return. It tells you the truth. Again, someone could be bragging 15% I'm getting from OMAH, but you're not. You're getting 7.5. So this is where I use it at 11 months old. So the risk factors, it's a limited upside. I'm seeing this a lot in these funds, and I see a lot in my OMAH fund, is the targeted 15 strategy relies on covered calls, create that income risk that we talk about, and it caps the upside, and the downside protection is very, very limited. So as I showed you earlier, the bull markets, the upside cap to that strike price, you're not going to have the growth that you're looking for. You're looking at maybe a 5% growth in a particular fund. So when you take a fund that's dropped off and you've had some NAV drop off, some negative growth, it's going to take a year for it to recover because of the cap side strategy. So the cap appreciation during sharp market rallies is going to be tight. Income may not offset the NAV drawdowns that we're seeing with every one of the funds. We see it heavily with OMAH, the Berkshire side. We're seeing that. It has its 15% yield coming in, but because of that 6%, at best, it's going to take a year for that to recover its NAV loss. So the net loss is actually possible, and that's why we always look at total returns. So the strategy is complex. It increases the behavior risk under the stress. Our second risk factor is tax implications, since it is tax season, and the NAV stability. Ordinary income tax rates on the premiums are going to reduce your net yield. Okay, this is where I always jump in and say right off the bat, you need to contact a tax professional. We're in tax season. Ask them about this stuff. It's not just about filling out the paperwork. Ask them about, hey, what do you think? Ordinary incomes, qualified dividends, non-qualified dividends. Where should I be putting maybe some of my money to help your situation, your tax side of it? The NAV erosion makes long-term recovery mathematically harder. The derivative complexity adds operational and counterpart risk, and high yield versus high total return if capital base declines. So these are some of the risks. The NAV side of this is a huge factor, and we just covered it in the last slide. It was very critical. We show you that these things have about a potential in a bull market of a 5% gain. And if you're losing 6, you're already down 1. So you're going to need that 15% to achieve what you lose overall in the NAV stability side of things. So these are risks to understand. And so again, by pushing hard at that total return side of it. So in summary, the key takeaways from the targeted 15, the VistaShares Target are very sophisticated income vehicles that require deep understanding of the trade-off between yield and capital stability. Now, none of the funds are over 1 year old yet, so I still classify all of these funds as new. We have 2 funds that will probably be, in the next 3 months, will probably be over that 1 year, and we'll be able to do a better research across the board, but I can already see what's happening. Are they hitting the targeted yield? As the funds show, they can meet the targeted yield, but the total returns are not as high. They're not holding the growth side of it. They're not getting the growth because of the way they set their programs up. The good for return accounts, they show signs of working in an income category fund only. So if you're not familiar, I've done a couple different videos on this, and we primarily dial this into retirement. Is that a fund? You want a stability fund, you want a growth fund, you want an income fund. Well, you can see with the NAV way it works, it's not a stability, it's not growing. The category would have to be income across the board. But you have to watch your NAV growth or your NAV loss. And the inherent risk is the market volatility, the limited upside, and the capital performance. So guys, the answer to it, for me personally, this is an income item only and is a 7 to 8% total return good for income. Each situation is different. I ask you, how does it fit you? Leave a comment below. What do you think of the Target 15s? Were you aware that we had this much total return differences? Love to hear your comments. If you like the funds, don't like the funds, like the video, don't like the video, leave your comments below. I'd love to hear from you.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments